Hi, everyone. This lecture is going to be about the income statement. So we are going to cover the income statement, depreciation, and in a separate video, we'll be going over profit does not equal cash. So there are three major financial statements of a company. The first is the income statement, the balance sheet, and the cash flow statement. So this lecture is going to focus on the income statement. And while the income statement has various names, it can be called an income statement, statement of operations, P&L statement, profit and loss statement. You should always be able to figure out an income statement because it contains revenue, cost of goods sold, gross profit, expenses, and net profit. So where can you go to find financial statements on a publicly traded company? SEC.gov is the most reliable website. It provides the 10K reports for a public company every year, and it is required for them to report to the SEC. So it is audited data, it is the most updated data, and that's your best source to find publicly traded information, publicly traded company information. You can also go to finance.yahoo.com, and there's a section where you can select financials, and then you can look at the income statement, balance sheet, and the cash flow statement. The problem with the finance.yahoo.com is it is accurate. However, Yahoo uses templated data. So if you're looking at the information from the SEC.gov, the numbers won't look like they add up to the way finance has it, because finance.yahoo.com uses these templates, and they'll sometimes take various categories and lump them into one category. You can also go to a company website under investor relations and look at their annual report. And I have here that it's not advisable. And the reason being is sometimes the company website will not contain an audited version of the latest financial data on a company. So if it's unaudited, that could differ from what you would find on SEC.gov. And in addition to that, a company website, when they post an annual report, it's usually for potential investors and used more as a marketing tool. So I would be weary of using the company website, and SEC.gov is the most reliable source, and you can download the financials directly into Excel. So here is what an income statement looks like. And this is an income statement for Netflix in 2020. So you can see that it has revenues, it has the cost of revenues, it has these expenses of marketing, so forth and so on. So again, remember, you'll always see revenue as the first line item on an income statement, regardless of what it's called: profit and loss statement, statement of operations, statement of financial results. So for example, if you went to the SEC.gov and you wanted to look at their financial statement, it would be called statements of operations. Microsoft uses income statements, right? So you'll be able to define it because revenue and expenses and net income, net profit will show up on an income statement. And the purpose of an income statement is to measure the products and services that a company provides are profitable. So you have components of an income statement, and you'll have what you might hear when you're working out an industry: above the line and below the line. Above the line are revenues, which are the sales that have been made by the company, and the cost of revenues or cost of goods sold. And those are the expenses incurred for making the product, right? So the example given here is if you sell coffee, there are expenses associated with bringing that product to market. You have to purchase coffee beans, and there's packaging, so forth and so on. So it's only the costs that are directly related to making the product. Then you have below the line, and these are all of the other types of expenses: marketing, technology and development, general and administrative, and they'll each contain, various sub departments under marketing, under technology and development. And so, for example, general and administrative really doesn't tell you much, but these are the expenses that run the business. It's the finance department, it's the human resources department, it's the legal department, and it could be depreciation. And other expenses that you'll see are the interest expenses as well. So here is a graphical depiction of if you're working in industry and someone says, what's the number above the line and what is the number below the line? So your revenues minus cost of revenues is above the line, and below the line is your net income. So this just shows you how you can relate your personal life to an income statement. In your personal life, you have revenue, which is in the form of a paycheck. And then you have expenses, which are rent, food, and utility bills, and entertainment, or whatever it may be. And the concept is you take your revenue, say your paycheck is $5,000 a month, and you see your expenses here for rent, food, and utilities, and you subtract that from your revenue. So your net income is $1,300. Which means you have $1,300 left over at the end of the month. So now I want to talk about depreciation, which I mentioned was under general and administrative expenses on the income statement. So depreciation is tricky, right? It's a non-cash expense, but it does appear on the income statement. So these are costs for computers, machinery, and furniture, all large amounts capital expenditures, right? Things that typically are over $1,000. And what you see on the income statement under depreciation, it's the value of an asset that is spread out over the life of the piece of equipment on the income statement, right? So there are rules in place that the IRS has where, you know, if you purchase a vehicle, they will say you can depreciate that over 5 years. If you purchase office furniture, you can depreciate that over 7 years, right? So what happens is you purchase a vehicle for $30,000. Well, how are you going to show that on the income statement? Well, you're only going to show that $30,000 over 5 years. And each year you're going to show that 1/5 of the 30,000 on your income statement. So there are different methodologies for using depreciation. And so we're just going to go with the straight line method, which is distributing the amounts that will go onto the income statement with set amounts, equal amounts each year, which is also known as the straight line method. So again, here's that example. You purchase a vehicle for $30,000 and it's going to last 5 years. So on my income statement, I'm going to show an expense for $6,000. And in year 2, another $6,000. And in year 3, you get the point. And then on the balance sheet, there's property, plant, and equipment. Notice that year 1 starts out the highest, and then year 2 it decreases, so forth and so on, until the life of the vehicle is no longer in existence. So here's the impact that depreciation has on an income statement. So on the left side of the screen, the income statement with depreciation. I have revenues of $25,000, cost of goods sold, COGS, $5,000. I have other expenses of $4,000 and depreciation of $6,000. So at the end of the day, my net profit is $10,000. If you look on the right side of the screen, if I treat that vehicle as an expense on the income statement in its entirety, I would show a net loss of $14,000. So this is done because this piece of equipment or this vehicle or this furniture has a lifespan. So rather than the company taking a hit for the expense all at once, the rules state that a company can depreciate that expense over the lifetime of that piece of equipment. So depreciation on the income statement will typically be under general and administrative expenses. And on the balance sheet, it would show under property and equipment. So every year that you depreciate something on the income statement, your property and equipment will go down. So in summary, the income statement shows revenue and expenses for a period of time, and the best source to find public company data is at sec.gov. The income statement has various names: P&L statement, statement of operations, statement of financial position. Revenue and cost of goods sold is considered above the line. Expenses, anything below those two items is considered below the line. And as I mentioned, profit does not equal cash, and we're going to get into that in the next lecture. Depreciation is a non-cash expense. It's the purchase of capital equipment that is spread out over the lifespan of the item that's purchased. And that last one really doesn't go. So sorry about that, folks, but I hope this makes sense to you. Talk to you soon.